Top of the day, and welcome to the Constructive House, where housing literacy meets housing legacy. I'm your host and mortgage advisor, LT Fulton, and this is the Daily Mortgage Briefing. And each day we like to set aside some time to break down what's going on in the market, how it affects real home buyers, and how you can use strategy, not stress, to get mortgage ready. So let's start your day off informed and empowered. And before we kick things off, do me a favor and hit the like button. And if you haven't already, go ahead and hit that subscribe and share. Share this to family members, friends, colleagues. Don't keep me a secret. You're not the only one that I'm sure is looking for help when it comes to mortgage literacy. And when it comes to building a constructive house. So make sure you spread that around, and it helps out with the algorithms, because we are here to simplify things and build constructive households when we're talking about mortgage and financial literacy. So today we'll be discussing why the house you pick can break the deal. And when we're talking about the houses that you can pick, we're talking about different residential property types. And to kick things off, I want to break down the three most common residential property types. That's single family homes. And these are standalone homes that are designed for one family. And to simplify things a bit, it's about how many kitchens are in one structure. All right. And this is the most common property type. This is the most common property type of residential property that's financed through mortgages, is a single family home. You also have multifamily homes. That's 2 to 4 units. And these properties have multiple units in one structure, such as a duplex or apartment buildings. These can also be financed. And investors often use these properties to generate rental income. So when we're talking about a duplex or a triplex or a quadplex, which has duplex will have 2 kitchens in one structure. A triplex will have 3 kitchens in one structure. A quadplex will have 4 kitchens in one structure. These are usually from investors who are using this as an investment property. So they're renting out to the 2 families in the duplex. So they're going to make money off of it. All right. But you get a mortgage for this. This is residential income. Once you're exceeding 4 properties in one structure, now we're looking at commercial versus residential. But here we're just focusing on residential properties. So you got your single family homes, you got your 2 to 4 unit, which is multifamily homes. Then we have some that are a little on that gray area, tricky side, condos and townhomes. All right. So when we're talking about condos and townhomes, these are the types of residential properties that share walls with other units. All right. You get mortgages for condos. However, they may have specific requirements due to the shared ownership of common spaces. Okay, so when you're thinking of a condo, just know they're sharing a wall with someone else. All right, it's a little different than a multi-unit home because the way they're designated. All right, the way that homeowners association may designate a condo, they have specific requirements due to the shared ownership of those common areas, where a multi-unit a duplex may not have certain requirements, designated requirements. That's kind of what changes a duplex from a condo, because you may see some homes and it's like, well, that's just a duplex, but it's the way that it's structured turns it into a condominium place. And I want to make sure it's understood on the 3 most common property types, because we're talking about today why the house you pick can break the deal. So remember, we got the 3 most common: a single family home, multi-unit home, and condos. All right. Those are the 3 property types. Now, what I wanted to break down today before we get all the way rolling into why the house you pick can break the deal, I wanted to talk about the market snapshot, so we can kind of know where things are as far as rates, so we can know where things are as far as the bond market, inflation, what the Federal Reserve is saying, and what housing inventory is looking like currently. Keep in mind, we're looking at 9:30 in the morning right now. So we're kind of going off of what the market closed at, as we'll get the full market snapshot throughout the day today. As you know, lenders reprice throughout the day. So anything I'm going over is more general mortgage knowledge than it is pinpoint accuracy. So keep that in mind as we break down the snapshot. But here's what things are looking at right now as far as interest rates go. Most lenders are offering rates around 6.2%, depending on your credit, your down payment, and your loan type. Of course, the IPAC, your particular IPAC is going to determine what your interest rate will be. Again, that's what lenders use to determine your mortgage eligibility. That's income, property, assets, and credit. All right, so keep that in mind. When we're looking at the market movers, that's the bond market, inflation, the Fed, and housing inventory. The bond market is reacting to slightly improving mortgage-backed security prices. All right, and what that means is when bonds get cheaper, rates usually go up. But on Friday, mortgage-backed security pricing ticked up just enough to keep rates steady. All right, so right now we're kind of in that stable standpoint. We saw a 12-month low come December where rates dropped to a 6.19, which we're going to say that's 6.2%, but we saw that. Rates hadn't been that low all year, the last 12 months, but they're still steady right there. We haven't seen them coming down from there. All right, as we're talking about inflation came in a bit hotter recently, which generally puts upward pressure on rates. All right, but that's where we're at with inflation. The Federal Reserve, they said that they're cautious about future rate cuts, and their comments always affect lender pricing. So whatever the Fed says, the banks and lenders, they bow down to it, and they're going to reprice based on the Federal Reserve's commentary. And what drives their commentary is what's going on with inflation, what's going on with personal consumption expenditure, what people are spending on their everyday items that they need to live. So if inflation's going up, interest rates are usually going up. Inflation go down, interest rates will go down. That's what the Federal Reserve uses as their indicator on what they're going to do about mortgage rates. And whatever they say is what goes when we're talking about the bond market, when we're talking about interest rates, when we're talking about the housing market in general. And while we're talking about the housing market, as far as housing inventory, things are still traditional for this time of year. Supply is improving. More houses are improving, but things are still tight in most markets because, of course, there's not always a whole lot of buying and selling going on during the January time of year, during the colder months. So it's pretty standard, pretty normal for how things are right now. That's what we're looking at as far as the market snapshot for today. Keep in mind what your particular interest rate is going to depend on your credit profile. So this is not a credit decision. So keep that in mind when we're talking about what's going on with your particular IPAC. And that's why you do need to get your free IPAC score at the constructivehouse.com. And you can fill out the questionnaire, see where you stand as far as on your IPAC profile. Remember, it's based on the 4 pillars to getting approved: income, property, assets, and credit. You fill out that questionnaire. It's free, and you can see if you're mortgage ready. It's not a pre-approval. It's not a mortgage approval, but it lets you know what you need to work on. And if you're ready to move forward today with getting approved, or if there's some things you need to work on, and me and my team will help you out when it comes to that. So keep that in mind. All right. Now, because we're talking about why the house you pick can break the deal, because property types matter. While we're talking about that, I did want to go over today's word of the day. All right. Because what would we be at if we didn't discuss the word of the day? And today's word of the day is going to be appraisal. All right. An appraisal is the type of report that tells the lender what the home is actually worth. All right. It's a report that tells the lender what the home is worth. That's an appraisal. All right. And the property type you pick will determine what your appraisal will be. Like it's all correlative. All right. And before a lender gives out hundreds of thousands of dollars, they want a professional to check the home's value, not just the listing price, not just what the seller hopes for. An appraiser is going to look at the condition of the home. They're going to look at the neighborhood the home is in and recent sales to make sure the price makes sense. Because anybody can say, oh, yeah, my house is worth $300,000. Let's put it on the market. Let me get that $300,000 and leave. But what if the house that you're trying to sell for $300,000 is really only worth $120,000? We got to make sure of that. And banks do not want to give a seller $300,000 for a mortgage if the house is only worth $120,000. They're not going to do that. So they're going to send a pro out there to check and make sure it's worth what they're selling it for, not just whatever they say out of their mouth. So remember, as a buyer, the appraisal protects you. It also protects the lender by confirming the value of the home, the true value, based on a certified appraiser, a professional. And that's the word of the day, appraisal. So keep that in mind, all right? Because we're talking about why the house you pick can break the deal. Please hit the like and follow for more mortgage tips, because we're going to be breaking this down. We're going to be simplifying how mortgages are the gateway to generational income. The financial wealth gap is based primarily around home ownership. So more folks need to have ownership when we're talking about property. And the property you pick can make or break the deal. So this is what you need when we're talking about building a constructive household. This is what you need. You need this information, and nobody else is going to break it down like I'm breaking it down. Nobody else is going to be this transparent when we're talking about what's needed to build a constructive household. When we're talking about mortgage literacy, when we're talking about housing legacy, nobody else is being this transparent. Nobody else is breaking this down for you like this. They're not going to take the time out to do it. All they want is for you to complete an application so they can get a closing and get their commission, and they're going to move on to the next. They could care less if you don't understand anything about the application. And I'm here to make sure that you always understand what's going on in the application, that you understand the behind the scenes, that you understand how underwriters are thinking, that you understand how lenders are thinking, that you understand how everybody is thinking. That way you can go in there and be an informed buyer. For most Americans, the biggest investment you'll make in your life is purchasing a home. So you need all the tools required to be an informed buyer. This is a big deal. This isn't just something you're doing to fly by night. This is a big deal. So keep that in mind. Now, what this means for you as a buyer, when we're talking about why the house you pick can break the deal, and we're looking at, in particular, an appraisal. All right. What does an appraisal really mean for buyers in today's market? Let's think about that for a second. What does an appraisal really mean for you as a buyer? Like, okay, I get it. Somebody's going to come out, say how much the house is worth. And from there, we'll decide if we're going to get the mortgage for that amount or not. All right. With home prices still shifting, as we went over on the market snapshot, the appraisal is your reality check. Okay. It tells the lender, and it tells you, the buyer, what the home is actually worth today, not just what the seller is looking to get out of it. That's one thing that strengthens it for you, because the lender is not only focused on you. Most times they don't care anything about you. They care about them and them getting their money back. That's what they care about. They're making sure that they're lending out the money and they're getting their fair share, their market value of it. All right. And in the meantime, if it helps protect you, because, the Equal Credit Opportunity Act says they got to provide that, they'll do that too. But if an appraisal comes in strong, what this means for you is you can buy with some confidence. All right. You know that it's worth what they said it's worth. All right. But if it comes in low, it's still a win for you as a buyer, because you have some leverage over that situation. You can get seller concessions. You can renegotiate the terms and conditions of the purchase agreement when we're talking about an appraisal coming in low. Now, if you already own a home and you're looking to do a refinance, then, hey, we got to have a different conversation, because a refinance, that means you already own the home and you find out your home is not worth what you bought it for. That's a whole different topic. And we got to really comb through that appraisal and see why it's not worth what you bought it for. It could be some small things that you are aware of, some cosmetic changes that got to get fixed, or we could have a bigger topic at hand that would need to be discussed. But that's why the house you pick can break the deal, and not just up front, but even down the road. If your home starts losing value, you become underwater. This came from the house you picked, and that can break your deal later on. So this is very important. This is very important to pay attention to the property you pick. Because the things that the appraiser is looking for when they're assessing your value, this is what you need to be looking for as well. What neighborhood it's in, what homes are typically selling for in the area, the condition of the home, the type of property, like we went over earlier. Is it a single family home? All right. Are there other single family homes in the area? All right. Is it owner occupied? Meaning you're going to live in it. All right. What about the other houses in the neighborhood? Are they being rented out or do the owners live in those houses? All these things matter when we're talking about the property type. All right. Next door, is there a duplex next door to you and another duplex and you're the only single family home on that street? All of these things matter. That's why the type of home you pick is very important. So make sure, that you're paying attention and you are subscribed. You do got your notification bell turned on because I'm going to be breaking this down for you on a regular basis. It's the daily mortgage briefing, not the annual, not the every so often mortgage briefing. This is every day that we're going over this. All right. And just to make sure we're on the same page in a market when prices are moving fast. If you're in a market where homes are flying off the shelf, the appraisal is your safety shield. It keeps you from getting caught up in the hype, okay? It's going to dictate how much the house is really worth. And make sure you're paying attention to that appraisal report. Go through it yourself. They deliver one to you, the lender. Make sure you're looking at it. Look at the other houses that they're comparing it to when they're talking about the square footage and what amenities that house has. Yours may have a fireplace and they're comparing it to a house that doesn't have one. You need to be on top of that because the house you pick can break the deal. You could go to sell it later on and be losing out on some money. So you need to make sure you are aware of that. If it's a duplex and they're saying it's a condominium or they're comparing it to a condominium, you need to make sure that is accurate. Hey, this is not a comparable. Because once they got that certified report, that's what they're going to be using. And if it's adding 10, 15,000 more dollars to your purchasing power, to your ownership equity in the house, your ownership stake, you need to make sure that's there because they shouldn't be comparing a duplex to a condo. They shouldn't be comparing a condo to a duplex. They shouldn't be comparing a condo to a single family home. So you got to make sure all of that is accurate because you're the one picking the house. And they're going to assume that you know better. Whether you know anything about property types, mortgages, interest rates, they could care less. That's on you as a consumer to be informed about that. They're not going to sit down and tell you this. That's why I'm doing it because I've done it for over a decade now, pushing 2 decades. And one thing that I'm noticing and have been over the years is that there are too many people who don't know anything about this. Way too many people who know nothing about this. Where this is something that's foreign. It's almost like speaking Japanese to somebody raised in the States speaking English. They have no idea about what any of this means. So I took it upon myself to be transparent and break down what's going on. Again, the different types of property. We're talking about single family homes, multifamily homes, and condos. All right. Multifamily homes are 2 to 4 unit properties. All right. That's residential. That's what I mean when I'm saying multifamily homes. Now, next, what I wanted to bring up was a quick math example to kind of help things out, simplify things a bit if I can, but that way you all are familiar. So as we're talking about quick math here, so we're going to break down a example. Some of you may fall in this boat, but we got a buyer who's approved for an FHA loan for $400,000. $400,000. However, the realtor's taken them out. They've gone and looked at different houses and they have fallen in love with a condominium. They're in love with it. They're like, oh man, I got a condo. I love this house. We want this house. We got to buy this house. Now, what some of you all may or may not be familiar with is government loans, FHA, VA, USDA. Well, USDA will knock this out. But FHA and VA, you got to be on an approved condo list for them to lend out that money because the government is backing that. They're the ones that are insuring those loans. It comes with benefits to use a VA or FHA mortgage product. They're insuring that. So if you're not on the FHA approved condominium list, you can't get an FHA loan for that condo. And FHA allows a lower down payment. You don't need 20%. You need 3.5%. Depending on some banks, you can get a 0% down payment, but you're going to need 3.5% down. All right. FHA allows you to have a lower down payment. So if you're not on the FHA approved condo list, you can't get that house. So let's break down the math. They fall in love with an FHA. They fall in love with a condo and they're approved for FHA. They want the smaller down payment. I get it. Now, this is how lenders break down math. This is lender math. All right. The condominium has an homeowners association, an HOA, and their dues are $450 a month. FHA requires the condo to be on an approved condominium list. All right. And it's FHA approved. It's not from the homeowners association. This is from the Federal Housing Administration. All right. Now, the HOA pushes their debt to income ratio from 45% to 52%. All right, we're talking about the homeowners association, $450 a month. That has to be included in your debt to income ratio. All right. And that's the I in the IPAC. They're looking at your debt to income, how much you're spending a month versus how much you make a month. That's what determines your debt to income ratio. And the HOA fee, that will be included in that debt to income ratio. That's included in your housing expense. All right. So it's not just the mortgage payment. The housing, the homeowners association is requiring that you pay $450 a month to live there. So let's break that down again. We're talking about the lender math. All right. You got the HOA charging $450 a month. That's pushing your debt to income ratio from being approved rating 45% to 52%, which is that gray area where you're going to need a stronger IPAC. Your assets and credit and property. Remember, we talked last week about reserves strengthening your IPAC. That's where that's going to come into play, because right now you're a little weaker on the debt to income side. All right. So the result on this particular math product, as you see, DTI is too high. The condo is not FHA approved. The deal dies. Even though the buyer was fully approved, because the property type they chose, which was a condominium, it ended up killing the deal. Now, that's on this math problem. I'm going to tell you, me as a mortgage professional, if that's the only thing that's getting in the way, we'll make that work. We'll make that work. 52%, we'll make sure we make that work. All right, I'm going to be honest with you. I'll find some ways to make that work. But when we're just talking about black and white, you don't want your DTI above 45%. You don't, because that makes it a challenge to get you approved. But can you get approved on FHA higher than that? We'll need some strong compensating factors on that IPAC. All right. But that's why the property that you pick can break the deal. So now they got to go back to the drawing board. Maybe they're in a city where condos are more common, like, New York or certain parts of like Northern California. You live in downtown type area. Condos may be more common than a single family home, in a lot of urban areas. So they end up finding one. They love it. The realtor showed it to them, but it's a condo and they got approved for FHA. So those things matter, and that's why the property you pick matters. So you need to make sure, especially if you're somebody picking a condo, you need to make sure, hey, if I'm FHA, first thing you should be asking your realtor is this on the FHA approved condo list? If it's VA, is this on the VA approved condo list? Because I don't want to go through all these steps, submit a purchase agreement. I'm going through all this bidding with other buyers just to find out I can't buy this house. Just to find out down the road it's broke, and you've been pre-approved. You've gone through, you got your credit checked. You submitted your pay stubs. You submitted your bank statements. You submitted your tax returns and your W-2s, and all to find out that this house needed to be on the FHA approved condo list, and it's not. And you find that out during the appraisal, because I've been there before as a mortgage professional. I don't even find out because the realtor was not upfront with me. The client wasn't upfront with me, and they all swore up and down this was not a condo. It was a duplex. And then the appraisal comes in and they're like, this is a condo. And we got them approved for FHA and they can't get the house because it's not on the FHA approved condo list. I'm reaching out to the association. The homeowners association is like, yeah, we submitted an application to be on the FHA list, but they haven't, they're still going through it. It'll be another year before we find out. So I'm like, we got to get another house. Everybody's mad at me. I'm the bad guy because I let them know the truth. So now I'm the bad guy, even though everybody wasn't being upfront with me. And I as a realtor, I feel that you should know what type of property you're showing to your clients. They should know if it's a condo, a townhome, a single family home, a multi-unit home. Those are the things that you should know. So deals don't die. So you don't break the deal based on the property type. So that brings us back to what we were talking about as far as our IPAC Spotlight of the day. That's property. Because, of course, we're talking about why the house you pick can break the deal. And from a property standpoint, condition, type of property, and location matters. Condos, fixer-uppers, and unique properties come with extra rules, all right? So before you fall in love with a place, make sure the home fits the loan, not just the other way around, all right? Stay on top of that, because property is the IPAC Spotlight for today. As we are talking about the house you pick breaking the deal, that's the IPAC Spotlight for the day. And I want to break down a real life example. I know I was just briefly talking about one, but I've seen buyers get fully approved, income solid, credit great, and still lose the deal because the property didn't meet lender guidelines. You got to remember, the bank is the one giving you these hundreds of thousands of dollars to buy the house. So they have guidelines too. So sometimes the issue isn't the buyer, it's the house. Maybe the roof is failing. Maybe there's more safety issues that, a certified building inspector found that you didn't see during the walkthrough. Or maybe the appraisal just flagged major repairs. The deck out back is dangerous. You step on it and it's leaning over every time you walk across it. All these things could be red flags. You know what I mean? So remember, getting approved is one step. Making sure the home qualifies is step two. They both matter. That's why I talk about the IPAC. The P in the IPAC is for property. Because a lot of folks, they focus on income and credit. But property matters too. Your income and credit could be strong, but if you're picking a property that doesn't work, you don't get that house because the lender's lending to the house. All right. You won't get it. All right. That's why it's income, property, assets, and credit. We don't leave that P out. That's the most important part. You're getting the money for the property. That's the most important part. All right. Keep that in mind. That's why you need to subscribe. That's why you need to hit that notification bell so you can stay informed and be an empowered consumer when you're going out here talking to these hot shots trying to sell you a house, talking to these hot shots trying to qualify you for a mortgage. Some of these hot shots are just out here talking crazy. Some of these hot shots are just saying anything to get your money. They just want to put you in an escrow. You're another one closed on the realtor side, on the mortgage professional side. They want to get that application originated so they can get a closing. They're not worried about if you're informed. They're not worried about what you do or don't know. And some of them aren't even worried about the house you pick, even though they may not get a commission if you pick the wrong house. It's ridiculous to me. I'll be honest, like very unprofessional. If they're not breaking down your questions and you're not asking questions, we're doing something wrong here. I was looking back last week and I noticed that just in the state of Georgia alone, 7 out of 10 folks are this close to the poverty line. This close. 7 out of 10 have incomes under $80,000 a year. That means they're 7 out of 10. Majority of folks are check to check. The majority are check to check. Missing 1 month of work. One car repair away from not paying bills. Now, if you pick the right property, you might have 2, 3, maybe even $400,000 of equity that can bail you out of situations like this. That's your money. So we need to make sure we are looking at the right things when it comes to picking the right property. This is going to be the biggest decision you ever make in your life. Owning a home, it's the biggest decision you'll ever make in your life. When we're talking about on the financial decision making, your personal financial portfolio, this will be the biggest money maker you have out of your whole portfolio. Make sure you're picking the right house. Make sure you're informed. Make sure you have all the right tools to actually go out there and build a constructive household. So I'm going to go over some do's and don'ts, give you some homework, and I'll let you on your way for the day. But when we're talking about some do's, there's 3 things that I want you to do. 3 things that you must do. All right. In order to protect your home buying process, in order to protect yourself, there's 3 things you must do. You must get property guidance before you make an offer. A quick review can save you some major headaches, save you time and money. Number 2, you must ask upfront about any red flags that were brought to you, any roofing issues, any safety problems, or anything that may stop a lender from lending to you, from approving your mortgage. And number 3, stay flexible. Have a backup home just in case something happens with this home. So while you're out there and you're house hunting and you're with your realtor, make sure you got 3 that you love, not just 1. It's just who do you love more out of the 3? Because if something happens with that one you love the most, you need to have a backup and then a backup just in case, because you never know, because the house you pick can break the deal. Now, we're talking about some things that you should never do. The 3 things I want to go over there. Do not fall in love with a home before you know it actually qualifies for financing. Do not wait until the appraisal to find out if the home has any deal-breaking repairs. Don't wait until the appraisal to find out about that. You need to be on your realtor about that. You need to be on the building inspector about that. You need to be on all of that. Do not wait until the appraisal comes in to find out that there's some deal-breaking repairs that need to be done. Because a lot of times it won't be able to be done in time to close on the home. You'll lose that home. You'll lose that earnest money deposit. You'll lose a lot of money and a lot of time. And the 3rd thing you should never do is do not get emotionally attached to one property before confirming you can get financing for that property. Never do that, because you'll find out, I've seen it too many times doing mortgages, that you fall in love with a house. This is the only house you want. You go through the entire process. The appraisal comes back and the home is designated mixed use and you can't even get it. You can't even get it. Or it's designated as a 2 unit because there's another property attached on the side or up here or whatever. There may be a home that they got sitting next to it that's on the same plot of land. And now you got to make a 20% down payment instead of the 3.5% down payment. Do not get emotionally attached to one property before confirming you can get financing for that property, meaning a mortgage for that property. Remember, it's not just about you getting approved. The property has to be qualified too. Follow the do's, avoid the don'ts, and you'll make smart moves. Keep that in mind. Now, as far as some action steps that I want you all to knock out for today. All right. Ask if the property type fits your loan. Always ask that. If you're looking at different houses on Zillow, Realtor.com, and all the other different websites out there, these are questions you need to be asking yourself. This is a question you need to be asking is, does this property type fit the loan program I got pre-approved for? All right. And I'm really talking about if it's a multi-unit, a condo, does this fit? Now, there are some others that a lot of mortgage companies tend to not lend on, but if it's like a mobile home or, these tiny houses, those property types, they're not the most common when we're talking about tiny houses, but those property types tend to not fit. So make sure you understand what property type you're dealing with. And that's a question you need to be asking yourself, especially if you're in the housing market, house hunting market right now. All right. But hey, if you all want to know how your IPAC stacks up today, take the free IPAC score at theconstructivehouse.com. Thank you for joining today's Daily Mortgage Briefing. Remember, you don't need perfect circumstances to buy a home. You need a strong IPAC strategy and the right information. So if you want help reviewing your IPAC score or planning your approval, the links are in the description. Once again, I thank you all for tapping into today's briefing. I hope you have a constructive